In this video, we will go over the top 5 biggest trading mistakes I've seen traders make over and over again. After you watch this video, you will know how to avoid these mistakes, and I can guarantee that you will become a better trader instantly. Hello everyone, welcome back to TradeSmart, let's get right into it. The first huge mistake I've seen made by others is trading on the Heikin-Ashi candles. We all love Heikin-Ashi candles. They look clean, they are easy to understand, and they are easy to use. So why we should never trade a strategy on the Heikin-Ashi? To explain it, let's put a Heikin-Ashi and a normal Japanese candlestick chart next to each other. On the top we have the Heikin-Ashi and on the bottom the Japanese candlestick charts. I positioned this chart in a way that the candles on the top and the bottom were printed on the same hour. At first you can't notice much difference, except that the Heikin-Ashi moves smoother. But let's say we have a full trading system and it gave a buy signal right on this candle. So, as this was the entry signal candle, we will enter a long position on the next candle's open. Let's put the stop loss to the recent swing low point and make this trade a 1 to 2 risk to reward trade. As you can see on the Heikin-Ashi chart, this would have been a solid winner. But if you take a look at the normal Japanese candlestick chart, you can see that the candle never touched the entry price level. As the candlestick chart prints the real trading prices of an asset, this means that the trade would have never been opened, as this asset did not trade it at that price level after the entry signal candle. So as a conclusion, any trading strategy that had been backtested on Heikin-Ashi chart probably will look fantastic, but that's only because those are fake results and the strategy cannot be trusted. The second common mistake I see many times is trading on very low time frames. In the comment section I usually get requests to show a 1-minute time frame strategy, and I totally understand that. Low time frame strategies compared to higher time frame ones will give much more trades per day, so it should also give more profits per day, right? Well, it's not that simple. The problem with trading on very low time frames like the 1 minute is that trading fees have a much higher effect on the performance of the strategy. Let me show you an example. Here you can see one of our premium trading strategy scripts on the 1-minute Bitcoin US dollar chart. It looks great at first sight, doesn't it? But let's open up the strategy settings and go into the properties tab. The current commission rate is set to 0%, meaning these results are only possible if your broker provides you 0% trading fees, which is almost never the case. With most of the brokers, you can manage to get away with a 0.05% trading fee if you do everything right. So let's set it up. Now if you take a look at the results, it looks terrible. If you were to use this strategy on the 1-minute chart, your account probably would have blown up within a few days. But why is this the case? Let's set up a simple trade on the 1-minute time frame and on the 50-minute time frame, then compare the two. For example purposes, I will use a simple MACD cross strategy. So when the MACD crosses up, we enter into a long position, and when it crosses down, we enter into a short. We will place the stop loss at the recent swing low and the take profit at a 1-to-1 risk to reward ratio level. On the left side you can see the 1-minute chart, and on the right the 15-minute chart. Now what we have to do is to check what is the price percentage difference between the entry level and the take profit level. On the 1-minute chart, it is around a 0.26%. And on the 50-minute chart, it is around a 0.63%. As you can see, the price target percentage difference is more than double on the 50-minute compared to the 1-minute chart. Now if we subtract the trading fees, which is 0.05% when entering the trade and also 0.05% when exiting the trade, then we are left with a 0.16 price percentage on the 1-minute and 0.53 price percentage difference on the 15-minute. This means on the 1-minute chart the fees take up around 40% of the potential profits, but on the 15-minute chart the fees only eat up 16% of the profits. And that is a huge difference. In my opinion, based on my own experiences, trading anything less than the 10 or 15-minute chart is very hard and you should avoid it. Except of course if you have 0% trading fees, which you can get with Binance if you trade only spot, Bitcoin BUSD or ETH BUSD pairs. If you are interested in that, you can sign up to Binance using our sign up link in the description. The third big mistake I often see is trading a strategy that have not been backtested enough times. You might be familiar with those 100 times backtested strategy videos. These are the most common backtesting videos, and a lot of YouTube channel does it. There is nothing wrong with it, and I highly recommend you to backtest also. The problem comes when people think that a strategy that has been backtested 100 times is proven to be profitable forever. And that's exactly when a lot of people loses money. Let me show you an example. Here you can see the results of a simple strategy. After 100 trades, the strategy made around 15% and has a 1.5 profit factor. These results are looking very promising for a strategy and could have been a 100 times backtested strategy video. Well, there's one thing I didn't tell you about this strategy. This strategy is restricted to only allow trades between the 4th of July and the 29th of July. Now, let's leave this restriction and see how well the strategy performs on a bigger time interval. As you can see, now the strategy looks useless. We didn't change any of the rules of the strategy, just increased the backtesting time interval. By the way, that 100 trade period was right here from the 337th trade till the 437th trade. As a conclusion, it is really important to backtest a strategy on as much candle data as possible, otherwise you risk your hard-earned money on a trading strategy that was only profitable for a short period of time. The fourth big trading mistake is not reading the entry signals correctly and as a result not backtesting a strategy correctly. When backtesting a strategy, amongst a lot of other aspects, there are two very important things. Which candle is the signal candle and which one is the entry candle? The signal candle is the candle on which all the criteria required by the used strategy are met. The entry candle is the candle after the signal candle, and the candle on which is open, we can enter into a position. For an example scenario, let's use the whole suit as our entry signal indicator. When the whole suit turns green, we can enter into a long position, and when it turns red, we can enter into a short. Here you can see that the whole suit switched from red to green color. But which candle is going to be the signal candle? And which one is the entry candle? Is this the signal candle or this one? If you said this one, I'm sorry, but you were wrong. While it might seem that the whole suit turned green on this candle, it is not true. Let's use the candle replay function and see where it really turned green. As you can see, we are getting closer and closer to that candle, and now we are there. If you check the whole suit lines color under this candle, you can see that it is still red. So this candle can't be your signal candle. But one candle later, the whole suit is now green. So this candle will be the signal candle. You may think that no one makes this mistake, but I've seen it happen over and over again on a few backtesting channels. And finally, let's see the last huge mistake I've seen multiple times. Recently, I watched a strategy backtesting video and I wanted to review it and backtest myself. What I quickly noticed is that the entry signal indicator repaints. But first of all, what is repainting? When an indicator repaints, it means that in live trading, the signals would have not been printed where the indicator now shows. For example, the strategy I was talking about used the ideal BB with alerts indicator. After I put it on the chart, we can see simple buy and sell signals. So if you were to backtest this strategy, the candle which prints buy or sell signals would be the signal candle. And we could enter into a position on the next candle's open. So for example, a short entry right here, a long entry here, another short entry here, and so on. I will mark a few signal candles with a line, and then we will check with the replay function if those are really the candles that printed the signals. Now let's use the replay button and check if the buy and sell signals are printed correctly. As you can see, on this candle there should have been a sell signal printed, but it is not showing up. One candle later, after it has already closed, the buy signal shows up on the previous candle. On the next example, the same thing happens. So basically, if you were live trading this strategy, there is no possible way to enter into the positions at the right time, as the real signals are printed with one candle delay. I also checked the signals on the 5-second chart to see how it really prints in live trading, and I noticed the same thing. On some of the candles, the indicator even removes the buy-sell signals that have already printed. To avoid repainting indicators like this, I recommend you to do the same thing I just did. So do a replay check and watch the indicator live, mark its signals, and after a reasonable amount of signals has been printed, check if they are still there. And also if the signals are printed live. I hope you learned something new in this video. If so, drop a like, subscribe and turn on the notification bell, and let me know in the comment section if you want to see another common trading mistakes video, cause I know a few other ones. As always, thank you all for watching, have an amazing day, and see you in the next video.